Hello and welcome to this course on working capital management. We have been discussing so far on what are the components of the working capital, what are the benefits of managing different type of components, what are the benefit and cost of high inventory, low inventory, account receivable, cash and credit payables. And then we also discussed what are the different type of working capital policies and requirements under the different circumstances, what is the cash conversion cycle and how the company can use it to use its business model to influence the working capital requirements. Now in this section we are going to look at more about the individual components of working capital to understand really how it should be managed. So the first component definitely is going to be the trade credit, which is also called account receivable. The trade credit basically is the difference between receivable and payable, that is the net amount of funds consumed as a result of those credit transactions. So company is using trade credit, giving the credit and taking the credit. So that is called the trade credit. Now the concept for the using and giving and taking the trade credit is pretty much the same. So we're gonna look at that now. The credit that a firm extend to its customers is called trade credit. Now, what are the different terms in trade credit? Usually there are terms like 210 net 30. So what is the meaning of that? The meaning of that is that if you pay within 10 days, that is you will get a 2% cash discount. Otherwise, you have to pay in 30 days. So after the discounting period. Then you have a and then the credit period. So that is the basically the benefit of the terms of called trade credit. Some countries there are no trade credit like that, no cash discount like that, means not officially announced by the supply, by the customer, by the company. It's just say okay, you need to pay 30 days, so there is no cash discount, but the company may issue like special offers to get the cash discounts. If you pay within certain timelines, you may get a cash discount just to collect the money faster. However, in some countries the companies they offer immediately that if you pay within this, you will get a certain discount. If you pay after this, you will not get any discount, but you can pay up to 30 days. So that is the meaning of this trade credit term. Now this is a graphical example of if you made $100 purchase within 10 days, you pay 98. After 30 days, you need up to 30 days, you need to pay 100 days, $100. So either you pay on 10th day to get a cash discount, or you pay on 30th day. There is no point in paying on 15th day, 20th day, or 12th day, or 17th day. Why? Because you are not taking any advantage of anything. You are not taking the cash discount advantage by paying them on 10th day or 9th day, and you're also not taking the advantage of the full credit limit, which is up to 30 days without, because you're not getting any benefit by paying earlier, right? So either you pay on 9th or 10th day, or you pay on 29th and 30th day, not before that, right? So that is the one principle in managing the trade credits. Similar way, when you are giving the credit, I mean, then you also need to say okay, if you in order to entice the customers to pay you faster, you may need to offer a very good credit discount, very good cash discount. So how do we calculate the cash discount, how much it should be? We're going to look at with the help of an example. So the trade market and market friction. So what is the market friction? There is a cost of the trade credit. You have to understand that, and it's calculated by equalized annual rate. So the way to calculate the equalized annual rate is, the formula is 1 plus r to the power n minus 1. So that becomes the annual rate because you are giving 2% discount for 10 days credit or 10 days cash discount, right? So that is not annualized rate. So we need to say, okay, how much is the annualized rate? What is the benefit of doing it? So we're going to look at the example to really understand it. So let us say your firm is purchasing goods from its supplier in terms of 150 net 40. So what is the meaning of this? Your meaning of what is the effective annual cost of your firm if you want to choose that not to take the advantage of trade discount offer? So how much you are actually losing, right, by not taking the cash discount? So if you pay in 15 days, you get 1% discount, right? If you, let's say you make $100 purchase you will be able to get one. You need to pay $99 in 15 days. Otherwise you have to pay $100 in 40 days. So basically what you are doing is you are using this $1 for 25 days, because you can pay now. Definitely you will not pay now. Yeah, you will pay only on the 15th day. You will pay $99, or you pay $100 at the end of 40 days. So basically you will be using $1. You can borrow that $1 and pay the money for 25 days. So that is what you're doing. So difference is 25 days. You could borrow $99 for 25 days and pay at the 48 days. So what is the annual rate of return? So normally you are getting a annualized rate of 25 days. So the interest, so this is how you will calculate, because your interest saving is 1 over 99%. So you are basically giving 1.01% interest for 30 days. Right. So there are 306, there are 14 cycles in which you are using this rate. 14 cycle, 14.6 cycles. How did we calculate that? We divide that for 365 divided by 25. So that becomes 14 cycles, because you are using this 1% discount only for 25 days, or only for 25-day period in a year. So 14 periods in a year. So your effective annual rate will become like this: 1.11 plus R, 1.10101 to the power of n, which is 14.6 minus 1. So that if you convert that into the solve this, then it will become 15.8%. So which means your annualized rate is 15.8%. So if you are paying interest to your bank which is more than 15%, you should not take this advantage, right? Because you're gonna say. But if you are paying less, then it's beneficial for you. You should definitely go ahead and use this, because you're gonna pay less interest to your bank while you are saving 15% here. So that's how we look at the similar way. You need to see from your supply, from your customers, how much is the market rate. If the market rate of normal credit in your industry is, let's say, 20%, if you offer 22% discount like this for cash discount, then it will be attractive for your customers to pay you in advance, especially when you are paying much higher interest rate. If you are not paying that much of interest rate, then you don't need to offer it. But this is how you can look at it. So that is the benefit of trade credit. So benefit of trade credit basically is to it's simple to use, and there are transaction costs, then the alternative source of funds. Sometimes it has, and it's a flexible source of money and can be used when you need it. You don't have to pay for it. There is no force, right? You are using it only when you need it, when you have extra funds. Plus it gives only source of funding to the firm, because they are not able to get they are not able to go to the market, they are not able to go to the bank for using it. So they have only this way to use the funds. And usually the firms use trade credit because it's compared to the secured loan, is because it's cheaper, and plus it's faster to get, and there is an indirect way to get the lower prices to only to certain customers. And also maybe doing the business, because of the business relationship, it may be more better for them, and because the long-term relationship, the companies understand each other, they can trust each other, so that's why they give the credits. If we have not done the business with the company in the past, usually you will not give an advance, or you will not give an credit immediately. You will put them on the cash discount, or on a cash payment basis for some time, until you really trust them. Because if you give the credit to everybody, you will have a very high bad debt, trust me. So in that case, if the buyer defaults, definitely supplier can maybe able to reseize the inventory as a collateral. Normally the trade credits are not with collateral, so it may not help that much.